what would you recommend that we use right now, this year, if we're putting our money away? Do you think the Public Provident Fund is the most efficient debt investment available?
Absolutely a must. Any person who is earning income of a sizable quantum, where, as you said, the rate of tax may be 20%, must consider PPF, because PPF has the best post-tax return over a very, very long period that we've been tracking it. And even today, the PPF is a very, very attractive investment. It becomes compulsory, it helps you to save, it locks in your saving. You, at the end of the lock-in period, you have a large capital sum that you can withdraw without having tax consequences. So all of this makes PPF a very, very important part of the investment strategy.
I have a couple of rebuts to that. One is, what if I already have my PF being deducted from my salary? Then doesn't it become a double effort? Secondly, a lot of investors find the PPF cumbersome because it's not the most efficient system to enter, besides which it locks me in for 15 years, and that's a really long time.
Yeah.
So, first of all, my first question is, if I have PF already being deducted from my salary, can I skip the PPF?
You should. You must consider it. I think, again, you must look at whether you can put away savings for 15 years and whether it will make good sense for you to have some lump sum coming back to you after 15 years. For some purposes, it may become very effective. And therefore, you need to have your life-saving plan, and you need to have all your lumpy commitments clearly articulated in order that you can do good planning.
There's another argument that comes up when we're talking about a 15-year investment, which is that over a period of 10 or 15 years, equity always does better than a debt investment. In that case, then, does it make sense for me to use a PPF, or should I be using a mix of the two? Wouldn't it be more efficient if I put that money in equity? How do I decide?
Definitely a mix. Definitely a mix, which will be driven by your propensity to take risk. And that is driven by the level at which your income is rising. So once you have figured out whether your income is on a strategic rising curve and you have a certain lump of savings to take care of, then you start allocating.